The dollar paradox. Why the most predicted collapse never happens. There's a story that gets told over and over in financial media. It goes like this. The US dollar is dying. Reserve currency status is ending. China is rising. Gold will surge. The collapse is imminent. Position accordingly. I've been covering monetary history and currency markets for 2 decades, and I've heard this story at least a dozen times. In 2008, during the financial crisis. In 2000, during the debt ceiling fight. In 2020, during COVID money printing. In 2023, when Saudi Arabia accepted yuan for oil. Every single time, the prediction was wrong. Not just wrong by timing, wrong in understanding how the global monetary system actually works. Today, I want to show you why the dollar collapse narrative persists despite being repeatedly disproven. The structural reasons why no alternative can replace the dollar. The hidden strengths that doomsayers consistently ignore. And the difference between decline and collapse, which matters enormously for understanding what's actually happening. This isn't cheerleading for America. This is pattern recognition based on how currency systems function in reality, not in theory. Because here's what 20 years of covering this has taught me. The story of dollar collapse sells much better than the messy reality of monetary inertia. But if you want to understand the next 30 years of global finance, you need to understand why the dollar's position is far more durable than the pessimists claim. Let's start with the fundamental question. What would it actually take to replace a reserve currency? Not in theory, but in practice. A reserve currency needs 5 characteristics, and you need all 5 simultaneously. First, deep liquid markets. Not just large markets, but markets where you can buy or sell billions of dollars worth of assets without moving prices significantly. The US Treasury market trades $500 billion per day. That's not 500 billion in total holdings. That's 500 billion changing hands every single day. To put this in perspective, the entire Chinese government bond market trades about 30 billion per day. The European bond market is fragmented across multiple sovereigns. There is no comparable alternative for parking $3 trillion in reserves where you can get in and out without disrupting prices. Second, legal protection. When a central bank holds reserves, they need absolute confidence those assets won't be seized or frozen except in extraordinary circumstances. The US legal system, despite its flaws, has 300 years of property rights jurisprudence. Independent courts. Predictable rule of law. China's legal system is subordinate to party control. Russia just demonstrated that authoritarian states will seize assets arbitrarily. Even Europe, with strong legal traditions, lacks the unified framework that gives dollar holders confidence. Third, full capital account convertibility. You need to be able to move money in and out freely anytime for any reason. No capital controls, no approval required, no limits on amounts. The yuan still has capital controls. You cannot move large amounts in or out of China without government approval. This is an insurmountable barrier to reserve currency status. No central bank will hold reserves they might not be able to access. Fourth, network effects. Every major bank has dollar clearing systems. Every major corporation has dollar accounting. Every international contract has dollar precedent. This infrastructure took 70 years to build and trillions of dollars to create. Switching would require rebuilding all of this from scratch. It's not impossible, but the coordination costs are staggering. This is why legacy systems persist long after superior alternatives exist. The switching costs exceed the benefits. Fifth, military and geopolitical stability. Reserve currencies have always been backed by the dominant military power. Not because military force directly props up the currency, but because reserve currency status requires that other countries trust you won't use their dependence against them except in extreme circumstances. The United States, for all its foreign policy mistakes, has been a relatively benign hegemon. Countries hold dollar reserves because they believe America won't capriciously weaponize their holdings. The 2022 Russia sanctions were viewed as justified by most Western nations because of the Ukraine invasion. China, by contrast, has used economic coercion repeatedly. Australia, South Korea, Lithuania, and others have faced Chinese economic punishment for political decisions. No country will make themselves dependent on a currency that might be weaponized unpredictably. Now, here's the crucial insight. You need all 5 characteristics simultaneously. Having 3 out of 5 doesn't get you 60% of the way there. It gets you 0% of the way there. This is why every dollar alternative has failed. The euro has deep markets and legal protection, but lacks unified fiscal policy and geopolitical cohesion. The yuan has government backing and growing trade volume, but lacks capital convertibility and legal independence. Gold has historical precedent, but no yield, limited liquidity for size, and massive storage costs. SDRs, the IMF's synthetic currency, have existed since 1969 and hold 0.3% of global reserves. Not 3%, 0.3%, after 55 years. This brings us to the central paradox. Why, if the structural barriers are so high, do smart people keep predicting dollar collapse? 4 reasons. First, availability bias. People remember currency crises, British pound after World War II, Argentine peso in 2001, Russian ruble in 1998, but forget the decades of stability in between. The pound remained a significant reserve currency for 30 years after losing primary status. It didn't collapse. It gradually declined while remaining important. Second, trend extrapolation. The dollar's share of reserves has fallen from 70% in 2000 to 58% today. If you draw a straight line, it hits zero eventually. But systems don't work linearly. They have tipping points, yes, but also stable equilibriums. 58% with no viable alternative is a stable equilibrium. Third, political bias. Many people want America to decline for political or ideological reasons. This colors their analysis. They see what they want to see. When Saudi Arabia accepts yuan, they see revolution. When you examine the details, Saudi Arabia is accepting yuan for 3% of oil sales to China while still pricing the other 97% in dollars. That's not revolution. That's a hedge. Fourth, misunderstanding historical parallels. Yes, the Portuguese real, Dutch guilder, and British pound all lost reserve status. But the transitions took 30 to 50 years, not 10 to 15. They happened through gradual multi-generational shifts, not sudden collapses. And they only happened after clear alternatives emerged. Britain lost reserve currency status to America because America had a larger economy, stronger military, stable democracy, and deeper capital markets. The transition was obvious in hindsight. Today, no such alternative exists. China is not the 1945 United States. The analogy fails on every dimension. Let me show you what's actually happening versus what the narrative claims. The narrative says dollar reserves are collapsing. The reality is dollar reserves are declining slowly while absolute dollar holdings increase. Central banks held $7.6 trillion in 2021. They now hold $7.8 trillion. The amount went up. The percentage went down because total reserves increased faster, mostly due to rising gold holdings and euro diversification. This matters. If countries were genuinely preparing to abandon the dollar, they'd be selling dollars, not just buying other assets in addition to dollars. What we're seeing is diversification at the margin, not wholesale abandonment. The narrative says petrodollar hegemony is ending. The reality is oil is still priced in dollars for 95% of global transactions. Saudi Arabia accepting yuan for bilateral China trade is economically rational. China pays in yuan. Saudi Arabia can use yuan to buy Chinese goods. But Saudi Arabia isn't pricing oil in yuan. They're not settling European sales in yuan. And they're certainly not holding yuan reserves in size. Why? Because what does Saudi Arabia do with yuan? They can't freely convert it to other currencies due to capital controls. They can't invest it globally because yuan capital markets are limited. They can buy Chinese goods or hold Chinese bonds. That's it. This is not a foundation for replacing the dollar. The narrative says BRICS nations are building an alternative financial system. The reality is BRICS is a political forum, not a monetary union. The members have divergent interests, competing ambitions, and deep mutual suspicions. India and China had a border war in 2020. They remain strategic rivals. Brazil and South Africa have virtually no economic integration with the other BRICS. Russia is under sanctions that make its currency unusable for reserves. The idea that these countries will coordinate on a unified currency is fantasy. But let's steelman the argument. Let's say I'm wrong and a real alternative emerges. What would that actually look like? Not a collapse, a transition. And transitions take decades. When the dollar replaced the pound, the process took 30 years, from 1914 to 1944. The pound remained a major reserve currency throughout. Britain didn't collapse, it declined from superpower to major power. That's a huge difference. If the dollar undergoes a similar transition, we'd expect the timeline to be 2020 to 2050 or longer. Why longer? Because the modern financial system is vastly more complex with exponentially higher switching costs. During this transition, the dollar might decline from 58% of reserves to 40 or 35%. Not 3%, not 0. A multipolar currency system where the dollar remains the largest single currency, just not dominant. What would this mean practically? Slightly higher interest rates for US borrowing, maybe 50 to 100 basis points. Slightly lower purchasing power for American consumers, maybe 5 to 10% over a decade. These are meaningful but manageable adjustments, not catastrophic collapses. The narrative of overnight collapse or 10-year Armageddon is economically illiterate. It ignores how systems actually change. Institutions, networks, and behaviors have immense inertia. This inertia isn't weakness. It's a feature of stable systems. Now, let me address the strongest argument for dollar decline: currency weaponization. When the US froze Russian reserves in 2022, it sent a signal to every central bank. Dollar reserves can be seized. This is a real concern, and it's driving real diversification. But notice what countries are doing. They're buying gold, not yuan. They're increasing euro holdings, not building BRICS currency reserves that don't exist. Why? Because the Russia sanctions were viewed as justified given the Ukraine invasion. Most countries believe their reserves are safe unless they invade their neighbors, and if they do invade their neighbors, no currency will protect them. More fundamentally, any alternative would face the same weaponization risk. China has demonstrated willingness to use economic coercion for political ends far more frequently than America. A yuan-based system would have the same risks with less legal protection. Here's what people miss. The dollar's strength isn't primarily military or political. It's structural. The depth of capital markets, the liquidity of treasury bonds, the sophistication of financial infrastructure, the reliability of legal systems. These took centuries to build. They can't be replicated in 15 years. They might be replicated in 50 or 75 years if a rival power sustains economic growth and political stability while building parallel institutions. But that's a multi-generational project. China is attempting this. They're building CEPs to rival SWIFT, internationalizing the yuan, developing bond markets. But they're facing the fundamental trilemma. You cannot simultaneously have a fixed exchange rate, free capital movement, and independent monetary policy. China wants all three. Economics says you can only have two. Until China chooses, likely by accepting exchange rate flexibility and capital account liberalization, the yuan cannot be a true reserve currency. And making that choice requires accepting loss of control, which goes against the party's fundamental philosophy. Let me be clear about what I'm not saying. I'm not saying the dollar will never decline. I'm not saying American economic dominance is permanent. I'm not saying there are no risks. I'm saying the timeline is far longer than pessimists claim. The barriers to replacement are far higher. The alternatives are far weaker. And the most likely outcome is gradual decline over decades, not catastrophic collapse in years. For 20 years, I've watched predictions of imminent dollar collapse come and go. The 2008 financial crisis was supposed to end dollar dominance. It increased it as everyone fled to safety. The 2020 money printing was supposed to cause hyperinflation. Inflation peaked at 9% and fell back to 3%. The 2023 Saudi yuan deal was supposed to break the petrodollar. Oil is still priced in dollars, every time the narrative oversimplifies. Every time the complexity of the actual system reasserts itself. Every time the structural advantages prove more durable than the structural criticisms. This doesn't mean complacency. America has real economic challenges: debt sustainability, political polarization, infrastructure decay, educational deficits. These matter for long-term competitiveness. But reserve currency status operates on a different timescale than election cycles or quarterly earnings. The question isn't whether the dollar is perfect. The question is whether anything else is better. And for now, the answer remains no. So where does this leave us? What should you actually do with this information? First, be skeptical of currency collapse predictions. They've been wrong repeatedly for good structural reasons. That doesn't mean ignore risks, but calibrate probability appropriately. Second, understand the difference between decline and collapse. If the dollar declines from 58% to 40% over 20 years, that's manageable. It's not zero, it's not catastrophic. Third, recognize that diversification makes sense regardless. Hold some euros, some gold, some real assets. Not because dollar collapse is imminent, but because diversification is always prudent. Fourth, focus on fundamentals. Economic growth, productivity, innovation matter more than reserve currency status. Countries don't become wealthy by having reserve currencies. They get reserve currencies by becoming wealthy first. Fifth, watch for genuine structural changes. If China liberalizes capital accounts, that's significant. If the US weaponizes the dollar against multiple countries capriciously, that's significant. If alternative payment systems gain real scale, that's significant. But headlines about bilateral trade deals are noise. The dollar's position is far more robust than the collapse narrative suggests. Not because America is perfect, not because alternatives are impossible, but because the structural requirements for reserve currency status are extraordinarily demanding, and no alternative currently meets them. This is the message you won't hear in viral videos predicting collapse in 10 years. It's less dramatic. It's less shareable. It doesn't drive subscriptions or gold sales. But it's what 2 decades of studying monetary history and currency markets has taught me. Systems change slower than we think. Alternatives emerge slower than we predict. And the gap between theory and practice is larger than models suggest. The dollar will eventually be replaced or joined by other reserve currencies. Everything ends eventually, but the timeline is measured in decades and generations, not years and election cycles. And understanding that difference is the key to navigating the next 30 years of global finance. So the next time you see a headline screaming about dollar collapse, ask yourself, what are the structural alternatives? What's the timeline for building parallel institutions? What's the historical precedent for the speed of change being claimed? And remember that the most predicted collapse in financial history keeps not happening for very good reasons. Those reasons haven't changed. They're not likely to change soon. And that's the real story of the dollar in the 21st century.